Let's look at a simple example. People will look at the so-called earnings of the S&P 500 to get some valuation or implied valuation of the market and whether that market is cheap or expensive. It's very superficial. It does not include the real economics that are being generated by those businesses. It's a theoretical, if everything worked out perfectly, for all 500 companies in that universe, those are the theoretical earnings that could be generated. The reality of what is being generated is a number that is not insignificantly much lower than that. So that when we think about risk management and we think about earnings power of an individual business that we're looking at, when we have to look at the overall marketplace, for example, when we take a company like Apple, there are aspects, because the underlying business is so strong, they don't have a necessity to force the revenue line or the earnings line in the way that maybe some other businesses in similar segments may be forced to do just to meet expectations or shareholder wishful thinking. And so to us, that has two very important functions. It has an important function in understanding what is the likelihood that that business is going to generate what we think it's going to generate from an economic perspective, but just as importantly in the investment process, it gives us tremendous asymmetry relative to another type of name in the underlying risks of an investment that we would make into that earnings power stream.